Marvell Technology is one company I evaluated throughout 2025, and I warned investors. Well, I shouldn't say warned, but I told investors I didn't think this stock was a buy. Even though it's got a good foothold in the AI industry, it still sells a significant percentage of its products into other industries that are not as lucrative as its AI business, and that's weighing down on the company overall. Its competitors like Broadcom are making great headway, and Marvell's finding it more challenging to gain market share in this lucrative industry. The stock is down over 45% year to date in 2025. But since the stock price is down so much, does that make it a buy on this dip? Is it a buying opportunity here? I'll answer that question in this video, and I'll share with you my proprietary discounted cash flow valuation model for Marvell Technology so you can see what I calculated as a fair value for this stock right now.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So one thing Marvell Technology has done well is grow its revenue, but that revenue growth has not been consistent and it has slowed considerably in recent years. So Marvell Technology from 2005 to 2025 has increased its revenue from 1.7 billion up to 5.8 billion. That's only good for a compounded annual growth rate of 6.7%. And the growth rate looks even more pedestrian if we ignore the boom during the pandemic years, where the company's products benefited as people spent more money on electronics. People were stimulated with more funds, more stimulus checks, more unemployment benefits, etc. And there were fewer places where they could spend their money, so they bought electronics a lot more than usual. So since then, its revenue is actually down 5.9 billion in 2022 and 5.8 billion in the most recently completed trailing 12-month period. So that can partly explain why investors are not so enthusiastic about Marvell Technology right now. But on top of that, if you look at Marvell's returns on investor capital, they are not, anything good. You see this big spike here at 263%. That was a one-off situation. More recently, however, since 2019 to 2024, the returns on investor capital have been negative. And I'm okay with companies generating negative profitability on the bottom line, negative cash flow, negative numbers are okay with me. As long as I see improvement, as long as I see progress towards improvement, as long as I see a positive trend line, which I'm not seeing with Marvell. It was negative 2.5% in 2019 and negative 3.7% in 2022. And I do see very minor improvement from negative 3.7 in 2022 to negative 2.7 to flat in the most recent year, but not enough improvement for a company that's been around for this long, right? It's been around since a few decades now. So not enough improvement, and the number itself is not very strong. All right, so now that we looked at the company's return on investor capital and revenue over the previous few decades, let me share with you my proprietary discounted cash flow model for Marvell Technology. And let me start with the end first. The fair value of this stock. I believe I've calculated this business is worth $54.12 a share today, but the current market price is $60.65. So even though it's down 45% year to date in 2025, it's still, I would say, fairly valued. I like to have a margin of safety of between 5 and 10% for my calculations. And from 54 to 60, it's almost exactly 10%. And so I would say it's fairly valued at this current market price. It's nearer to its 52-week low, which is $47, than it is to its 52-week high, which is $127. And the stock is down over 3% today. Now, the weighted average cost of capital I used for Marvell is 13.88%. I provided a cost of debt. I estimated a cost of debt of 7.5%. The cost of equity came in at 15.5%. And I used the capital asset pricing model to calculate the cost of equity, which takes the beta as the risk factor in the analysis. And Marvell Technology has a relatively high beta of 1.83. And remember, beta is a measurement of risk. What beta measures is it takes the stock price of a company like Marvell and it compares it to the price movements of the S&P 500 index, and it measures the magnitude of price change comparably. It does a regression analysis, and a beta of 1.83 means that every time the S&P 500 index moved up by 1%, the Marvell Technology stock price moved up by 1.83%. So it's 83% more volatile than the S&P 500 index. Whatever the S&P 500 index does, the average for Marvell has been an 83% stronger magnitude movement, both on the upside and on the downside. So that means it's more volatile, it's more risky. The price goes up and down more significantly than the average business. And so when I evaluate a business like that, they earn a higher cost of capital because all else being equal, investors prefer less risk. If we're going to take more risk, if I'm going to take more risk, I want more compensation for the risk that I'm taking, right? I'm not afraid to take risk, but I'm not just going to take risk for no reason. I want to be compensated for taking that risk. And so that's why I increase the cost of capital when I'm evaluating a company that I see as being more risky, right? Another way I like to look at valuation is measuring by the forward price to earnings ratio. And at 21.77, it's near the lowest it's been going all the way back to 2019. But the company's revenue growth and profitability metrics means that it doesn't deserve very much of a premium valuation. So a forward PE of 21.77 seems fair to me, if not, a little bit overvalued given its prospects. But I will lean towards saying it's fairly valued here on a forward PE basis, as well as on my discounted cash flow valuation basis, but leaning closer to being overvalued than being undervalued. In my margin of safety, it's on the higher side of the margin of safety rather than being on the lower side of the margin of safety. So, oh, by the way, these charts I'm getting from FinChat. I always get questions about where are you getting these charts from? FinChat.io. There's a link in the description. You get a discount for using my link. So to update my recommendation, which I told you I've not had the stock rated as a buy. I had it rated as a hold all year long, and I last updated that on April 11th, reminding investors that I didn't think it was a buy. And I'll let you know again today that I don't think this stock is a buy, even though it's down so much off its high.
Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.